the case is as follows. We are studying Caterpillar Inc., which is one of the largest manufacturers of construction equipment in the world. Okay, they are in the US. What method do you think they use, LIFO or FIFO? They are a US based company, so for tax reasons that we will see shortly, they use LIFO. Okay, now an analyst wants to compare this with maybe a European company, and to compare, he wants to convert all Caterpillar generally called CAT, so all Caterpillar's numbers into FIFO. Okay, so that's what we are doing. We are told that the tax rate in 2008 is 20%, and in earlier years, 2007, 2006, it was 30%. Okay. After giving you the way I have simplified this for you is, I am you've been given in the curriculum 3 pages of financial statements. All I've done here is taken the question and then zeroing in on the relevant segment. So the first question was, what inventory value would CAT report for 2008, 2007 and 2006 if it used the FIFO method? Now to check your recollection, so inventory using FIFO is, what's the formula? It's inventory using LIFO plus the LIFO reserve. Okay, so you look at the notes. Now the notes can present this LIFO reserve in one of many ways. Let's say what the note says. So the note I hope you all know this, that in the balance sheet, the inventory will just be one line item. There will be a footnote number 9 or whatever. Then when you look at the footnote, that's 2 pages of footnotes on inventory. And in those 2 pages, one of the pieces of information will be, if FIFO method had been used, inventory would have been 3183 and 2617 and 2403 million higher at 31st December respectively. Okay. So what does this mean? Yeah, so they have given the change. So what they are saying is the following. So what is this number over here? Inventories from your balance sheet under current assets for 2008, 8781. What does this number mean? Inventory according to LIFO, so that is 8781. And they are telling you that if FIFO method had been used, then inventory would have been 3183 higher than what is reported in 2008. Okay, the rest are for 2007 and 2006. So what's the LIFO reserve? It is plus 3183. Okay, so you do the math and that will give you your FIFO inventory. Okay, so that's fairly straightforward, just a plug and play based on the formula that you now know. Okay, what do you think they will ask you next? Okay, so the next will be for cost of goods sold. So what amount, we'll just do 2008, obviously for the rest of the years it's the same method. Now again, so what is COGS according to FIFO is equal to COGS according to LIFO minus what? Minus the change in LIFO reserve. Okay, what is that equal to? So what is COGS LIFO in 2008? So that is this number 38415 minus, how do you figure out the change in LIFO reserve? Yeah, so the way you get the change in LIFO reserve, if you say this number over here represents, so if this is 2008, okay, so if this is 2008, this is the beginning, this is the end. The 3183 represents the LIFO reserve at the end of 2008 or beginning? So this is the LIFO reserve at the end, 3183. What's the LIFO reserve at the beginning of 2008? Yeah, that is the, so ending of 2007, which is 2617. What's their difference? 3183. is 566. Okay, so you minus 566, and that gives you your cost of goods sold under FIFO for 2008. Okay, so so that's easy. Just need to make sure you memorize this formula. Okay, next, what net income would Caterpillar report for 2008 if it had used the FIFO method instead of the LIFO method? Okay, now first of all, intuitively, given that we have rising prices, would the income be higher or lower? Yeah, so that is the first piece of intuition. We are told that with the LIFO method, this is the income. Okay, now how would you do this? Okay, the way you do this is you take the change in the LIFO reserve. So, and then the change in LIFO reserve is the benefit that you are getting. What was the change in LIFO reserve? 566. So this 566 is actually doing what? This is increasing your additional income. But then you should always put in the tax effect, 1 minus T. The tax rate I told you was 20%. So you have 566 into 0.8, which is 453 approximately. And then that means that your net income according to FIFO would be 4010. Okay, so that's higher, and it is higher by this amount. The change in LIFO reserve into 1 minus T. I like the way the curriculum has done this. So this is that same question, and this is what the curriculum says, and this is a little more intuitive. What I just said is the fast way to do this on your exam, but the detailed explanation. So they are telling you that net income for 2008 according to LIFO is 3557. Okay, then the reduction in cost of goods sold, so which is the increase in the operating profit, so is 566. Do you understand this number? So remember, why is there a higher net income? There is a higher net income because there is a higher gross profit. Why is there a higher gross profit? Because there is lower COGS. How much lower is the COGS? The COGS is lower by 566, which was the change in LIFO reserve. So that's where the 566 comes in. If your cost is lower, what happens to your tax? The tax is higher. The tax is higher by how much? It is higher by 113. What's 113? It is the tax rate of 20% multiplied by 566. So this 113 is what you are subtracting. So on the earlier slide, we simply lumped this together into saying 566 into 1 minus the tax rate, but literally this is what is going on. Okay, now why do people use LIFO? For the tax. Now the next question is, how much is the tax benefit? How much do you think based on looking at? So in 2008, what was the cash flow benefit of using LIFO? 113. So this is a very straightforward question. By what amount would CAT's 2008 net cash flow from operating activity decline if for some strange reason they suddenly switch to FIFO? Then what will happen to the cash situation? Yeah, the 113 million, where did the 113 million come from? Yeah, so that's the tax saving. So if they go to FIFO, then what will happen? So with FIFO, their income will go up, and if income goes up, the tax will go up. The tax will go up by how much? 13 million. Is tax a real cash flow? It's a very real cash flow. So if the tax goes up, that means your cash will come down. There are other little subtleties that we don't need to get into, but effectively the cash goes down by this much. So that is the benefit of using LIFO. Okay, so that's why in the US, all companies that can use LIFO typically use LIFO. In the rest of the world that use IFRS, why do people not do this? Because it's not allowed. If it were allowed, then people would do it. Okay. The next question is, what's the cumulative amount of income tax saving? Now notice this keyword cumulative. What do you think this, so how do you figure this one out? Yeah, so if you have the cumulative amount, then the point is this. Actually, there is another subtlety in this question, and it is more difficult than probably what you'll see in the practice problems and in your actual exam. But obviously, to figure out tax savings, you need to know the tax rate. If you recall what you've been told, in 2008, the tax rate is 20%, and before that, it is 30%. So, what was your tax saving in 2008? It was 20% of 566, which was the change in LIFO reserve, which is effectively your the savings that you made on COGS, plus what? Plus 30% of what? Yeah, so actually then this becomes the change in reserve from the time they started till the beginning of 2008, which effectively means 30% of the LIFO reserve at the end of 2007. So the LIFO reserve at the end of 2007 was 2617. So 30% of 2617, you do the math and you will have 898. So 898 million is the taxes that Caterpillar saved by using LIFO. Okay, a pretty large sum of money. Okay. Now, all these things that we are doing in this example are things that you will see in the practice problems and which you might see on your exam. So, that's why this is so important. What amount would be added to retained earnings if FIFO had been used? Now, here they are telling you that amount would be added, but on the actual exam, they might not be so gracious. So, you already know from an earlier slide that FIFO retained earnings will be more in period in an inflationary environment. So FIFO retained earnings is LIFO retained earnings plus LIFO reserve into 1 minus T. So do we know so we are already told the LIFO retained earnings. So I'll just effectively read this solution. The amount that would be added to CAT's retained earnings is this million. And how is this calculated? So effectively it is the 566 into 80% plus 2617 into 70%. This represents the cumulative increase in operating profit due to the decrease in cost of goods sold. So effectively what we are saying is, if they move to FIFO, what will happen to profits? Profits will go up. Okay, how much would profits go up by? It depends on how much profits go up by, depends on two things. It depends on the change in LIFO reserve and the tax rate. So in 2008, the change in LIFO reserve would have been 566 and 1 minus T is 80%. For everything up till the end of 2007, the change in LIFO reserve was 2617 multiplied by the tax rate 1 minus T, which is 70%. So you add these two, and this is the amount that would be added to retained earnings. Okay. Next, change in cash balance. So if the company used FIFO, then what we've already sort of talked about this. If the company suddenly decided to go to FIFO, then this entire amount, 898, would have to be paid as taxes. So if that company is paying that amount in taxes, we just calculated this in question number 5. Okay, so then the tax, because of that, what will happen to the cash balance? It will come down by this much. But as you might expect, this is just purely analytical. Companies don't just change from FIFO to LIFO. Okay, and then now the final point in this example. What is the impact on ratios? So what's the formula for inventory turnover? We've already done this. So this is COGS divided by your inventory. It might either be average or end inventory. So if you look at our numbers with LIFO, it is 4.81. Does it surprise you that with FIFO the number goes down? It does not, because with FIFO, what happens to inventory? The inventory goes up, and what happens to COGS? Goes down. So obviously overall your ratio has come down. So even though operationally the company is the same, but if a company, and why do we do this? Why does the CFA make you do this? Because as an analyst, if you are comparing two companies, you can't just look at, and let's say the two companies are using a different cost flow method, you can't just look at this number and say that this LIFO company is more efficient. All else equal, when inventory turnover is higher, what does that imply? Better, more efficient, faster, better inventory management maybe. But can you conclude that based on this? No. The difference is purely because of the different accounting convention. What about, this is again testing your recollection from level 1. What's the days of inventory on hand? What's the interpretation and what's the formula? Yeah, so this is 365 divided by, so if you do 365, so it's 365 divided by 4.81. I found this a little amusing. I did this and I didn't quite get this number. So then they go back and say 2008 is a leap year. So there it is 366 divided by 4.81, in which case you will get exactly this. I doubt that on the exam they will do something like that with you. But fundamentally it is 365 divided by the, and what's the interpretation of days of inventory? It is a measure of roughly how long you keep your inventory. So lower is better. Obviously this is simply an inverse of inventory turnover. Gross profit margin, so that's your gross profit divided by sales. Okay, now with LIFO, your gross profit is lower. So therefore, as you would expect, the gross profit margin is lower for LIFO. Net profit margin is also lower for the same reason. Return on assets is what? Okay, so then this is interesting. Why? So assets are lower. So if you look at LIFO, net income is lower and assets are also lower compared to FIFO. The point here is, if you look at the impact, the assets, the inventory is a small percentage of overall assets. So the assets being lower is just slightly lower in percentage terms, but in percentage terms net income is a whole lot lower. So the overall impact is that net income will be lower for a LIFO firm. What's current ratio? Are current liabilities impacted by the inventory flow assumption? Yes or no? No, liabilities are not impacted. So the liability is not impacted. What about current assets? So who will have a higher current asset? FIFO will. So FIFO will have higher, LIFO, this guy will have lower. Okay. And what about this final one? Total liabilities to equity ratio. So the liabilities are not impacted. Will LIFO have lower equity? Why? Because the way you can simply look at, the simplest way to look at it is, liabilities are not impacted. So if LIFO has lower assets, then it will have lower equity. Okay, so that means if equity is lower for the LIFO firm, then the ratio of liabilities over equity will be higher.